With the U.S. government shutdown still happening and interest rates looking uncertain given what's going on with the taper or no taper, investors want returns. For the latest strategies in creating a sustainable and growing dividend portfolio, we're joined by Pankaj Patel. He is head of quantitative research for ISI Group, and he joins us from the NASDAQ. Pankaj, thanks very much for joining us this morning. Give us some background on the models you use and the inputs for the sustainable and growing dividend portfolios that drop out of your models.
Thank you, Francis, for having me. As you mentioned, investors are looking for the yield. When you look for yield, you have to be careful about value trap. To use dividend yield as a factor to select stock, it needs to combine with other factors like payout ratio and dividend growth. We tested within S&P 500, companies with high yield, low payout, and high growth outperform S&P since 1980 through present by 6%, and from 2000 through present by 9.7%. And even more recently, for the most recent third quarter, it outperformed S&P in every month with outperformance of 82 basis points.
It sounds like a pretty simple strategy when you think about it. Talk to us a little bit about what sectors are showing up right now using those three indicators that you highlighted.
And most people will be surprised. The biggest sector is showing up right now is technology. The second biggest is consumer. And then third one is financial. So if those three sectors make 66% of the portfolio, there are 42 stocks in our most recent basket. 11 are from financials, 11 from technology, 9 from financials, and 8 from consumer discretionary.
Consumer makes sense. Financials, I would wonder on the sustainability part, given what we just went through in the financial crisis, there were a lot of companies that had to pass on their dividends.
Yeah, so keep in mind, we look at dividend yield, the payout ratio, and the dividend growth. So 9 companies which we include in our portfolio, which are financial companies, they all meet those criteria.
And when you look at anything that surprises you that drops out of this analysis, any companies or sectors that surprise you? You said technology might surprise us. What else surprised you?
What else surprises? You look at utilities. We do not have any stock from utility sector in this portfolio at this moment. Typically, when you think about a dividend portfolio, investors always assume or think that it will be loaded up with utilities sector.
Most people would think that. There are none right now. When you're looking at payout ratio, what is a threshold?
Well, again, we do not use any threshold. The payout ratio for all the stocks in our portfolio is around 35%. So they are only paying 35 cents out of every dollar they earn. So they still have 65 cents in reserve in case if the earnings doesn't matter next year, they will have cash to pay out the dividends.
How often does this portfolio change?
Well, we change this portfolio every quarter because we get data every quarter. As you know, in U.S., companies pay dividend every quarter. And every quarter we get new data, and we always look at trailing 12-month data when we are looking at the companies to include in this portfolio.
And I think we're going to show again some of the names that shows up. So you rebalance every quarter. What about things that are going on around us in terms of, what's going on in Washington, rising yields, in particular rising interest rates? How does this affect the dynamics of this portfolio?
Well, as I mentioned, I'm a quantitative research person, so we are disciplined. So we go by the rules, we set it up, and then just play by that. And also to show that even more recent quarter, as the yield has moved up, or the bond yield has moved up, but this portfolio continued to perform. And as I said, in the third quarter, this portfolio outperformed by 82 basis points, and most of the outperformance was actually in the month of September.
And you went back, we were just showing that chart of the outperformance, and pretty healthy outperformance. What do you say to investors who just say, again, they just want the high yield and they don't pay attention to these other things? So what would be your last words to them?
Well, last word to them would be that be careful about high yield only, because high yield can be a value trap, as I mentioned before. And the yield can be high not because of the high dividend, but because the price went down and maybe for the right reason. So you want to avoid those stocks and make sure you look for yield, payout ratio, and dividend growth, all three combination.
Pankaj, thank you very much for joining us. Great insight into building a yield or an income-oriented portfolio. Sustainability, that's the word of the day. Thanks for joining us.
Thank you, Francis.
Pankaj Patel, he's head of quantitative research for ISI Group.